And I'll try to post those up sometime tomorrow. So it is there for you for your reference. And I am going to put up the textbook here, which, let me get my recollection, correct me if I'm wrong, is that we had sort of left off at module 4, right?
Yeah.
Yeah. Okay. Okay, good. So let's go ahead and let me very gently put the machine into tablet. Okay, all that music generally means that something has screwed up. So let's see. You can't see me now. So I'm going to hit start video and we're back there and you can hear me okay? Okay, good. So not too bad of a situation, I guess. Okay. All right, good. So I want to go ahead and having done that now, I have a presentation that is on e-learning and it is titled, I want to say the way it's showing up on e-learning, and of course I've closed that now. So let me reopen that. It's always got to be something. Oh, there it is. It's still open. The way it's showing up is chapter 8 slides. Okay, and I used some of this last time, but I'm going to go ahead and use the rest of those slides for some of this information that starts in module 4. It's the same information, but I have presented in a manner I think that flows a little better than what they have in the textbook. So let's just turn our attention to that file. If you haven't downloaded it yet, that's okay. You can look at it because I've kind of marked it up for you ahead of time anyway. And let's just go ahead and take a look at, I don't have my clicker, contributions. And guys, I'm sorry, I'm going to take it out of PowerPoint slideshow mode. It's too difficult to work with it, so you may need to look a little closer. But let's look at contributions involving an intermediary. So what happens here? Let's say you're working for one of the accounting firms and they have an annual campaign where they ask you to give money to United Way. Or when I was working for the federal government, it was the combined federal campaign. And what happens is not-for-profits will line themselves up with these organizations like United Way, like the federal combined federal campaign, because they get a broader potential base of donors by affiliating themselves with a nationally or worldwide known organization that gets money on behalf of not-for-profits. Now, when they give you your options to contribute to, say, a combined federal campaign or United Way, they'll say, well, are there particular not-for-profits that you want to give your contribution to? If you go through and you check the box and say, yeah, I want my money to go to Save the Canines, or remember our little not-for-profit, well, what happens is the financial intermediary at that point, United Way, let's say, has a liability because they have an obligation to remit that money to the not-for-profit. So at that point in time, we are said that United Way has not been granted variance power for that contribution. And what happens is they debit the asset, probably cash, they credit a liability. And United Way then would say, hey, we have a receivable, and not United Way, but Save the Canines would say, we have a receivable and we have a contribution that we're going to take for that amount that's going to be coming to us from United Way. Now, you could just give money to United Way and say, hey, look, you decide which of the not-for-profits that you're affiliated with to give this money to. If that's the case, then United Way would debit the asset, probably cash, credit contribution, and beneficiaries that may be affiliated with United Way would make no entry because there's no obligation to give that money to them. those are the two common cases, most common cases that we see in CPA exam questions where we're going to address intermediary accounting. I'll show you a third option, but I'm going to turn back to the book for that information when we get to that. Okay, so let's just take a look. And again, is the reason I said it's not a big deal if you are able to download these slides, because I've kind of already emphasized the key information on these slides that are on e-learning. So as a general rule, the intermediary recognizes an asset, debit, the asset, probably cash, and a liability to the beneficiary when it receives a contribution from the donor for the beneficiary with no variance power. So in our little example, the recipient would be United Way, the beneficiary would be Save the Canines. Okay, so when that money comes in and you're saying, hey, give that money to Save the Canines, they would debit an asset and they would credit a liability. Now, when you come over, we say an exception occurs. An exception occurs if you had granted United Way variance power. In other words, you told them they can give the money to whoever they want. Well, if that's the case, then they would debit contribution, or if they are some sort of captive. In other words, they are a foundation of the other entity. So now it's a foundation that a university has established. The foundation is collecting money that ultimately has to go to that foundation, then that would be treated differently. We're going to talk about that when we get back into the textbook. But let's go ahead and talk about the first case, focusing on the situation of variance power. Okay, you can see that I've pre-highlighted this. So I'm just going to go through the areas I've highlighted here. And we say that principles are largely driven by the application of the concept of variance power. The FASB pronouncements considers the common situation of the foundation, the recipient, which raises money for another not-for-profit, the beneficiary. Now, if the recipient gets the money without variance power, in other words, you have directed them how to use that money, there will be a debit to an asset, probably cash, and a credit to liability, because they're ultimately going to have to give that money over to, in our little example, Save the Canines. Now, just continuing over, I say see item B, the next page, and item B on the next page. Now what happens for the beneficiary? When the money has been received by the recipient, say United Way, the beneficiary would be Save the Canines, and the money was given to United Way without variance power. Notice they debit a receivable and credit a contribution because they know that money's coming to them, because you directed United Way to give the money to Save the Canines. Now, if you go back up, and now I'm dealing with the recipient accounting, and now the situation is you've given them the money with variance power. Now you've given United Way the money, said, give it to any not-for-profit that you're affiliated with. I'm not going to pick and choose one. Well, when they receive that money, they debit asset, they credit contribution. And if you follow that little, what's supposed to be an arrow, but looks like some sort of weird long note coming down there, for the beneficiary, now, when the contribution was received by the recipient with variance power, they make no journal entry because they don't know if that money is ultimately coming to them. Okay, question. Okay, now what I want to do is I want to look at this question. The only problem is we have the old terminology here, temporary restricted and permanently restricted. Just think of those two columns, guys, as one big column, contribution with donor restriction. Okay, just think of that as though it was one big column. But this question, I like to stick with it because it does a good job in illustrating the key points that I want to get to here. So I'm going to try to make that a little bigger on the screen. I don't know if that's going to help much. You might want to make your screen as big as possible. Okay, but for your in Zoom there, but I'll just read it out to you. The City of Lawrence United Way received a donation of a vehicle from a concerned citizen on January 1st, 20X1, Who directed that the vehicle be donated by the Lawrence Daycare Center, a not-for-profit organization, and went on to stipulate that Lawrence United Way could use the vehicle for a period of 1 year prior to the transfer. Now let's stop and think for a second. So what? For the last 2 years of this vehicle, Lawrence has not received variance power. They have to turn it over to the daycare center at the end of the first year. But for the first year, they have received variance power over that because they can use it for 1 year. And then they go on to tell us that the Lawrence Daycare Center is a United Way organization, but does not have an ability to influence United Way policy. And United Way elects to use the vehicle for 1 year. Okay, so they took and they show us, or they're asking us the accounting for each organization, United Way and the Lawrence Daycare Center. Now, really, you really gonna do this to anything? Ponderous. How long have I been dealing with this computer now? For 6 months. If you look back now, you can see that I put journal entries underneath each of the organizations to illustrate what they would do when this contribution is received by United Way. So notice that United Way does what? It debits vehicle for the 9,000. Credit contribution for the 3,000 would be a contribution, and they could probably credit contribution without donor restriction because they're going to use that vehicle for that 1 year and they're not going to be worrying about any depreciation in future years. So they would just go ahead and credit the unrestricted contribution. And then there would be a liability for the portion that they don't have variance power because they have to turn that remaining 2 years, the remaining 2 years of value, over to the Lawrence Daycare Center. Lawrence Daycare Center, because they're going to get the value of the last 2 years on that, will debit receivable because they're not going to get that for a year, and credit the contribution for 6,000 because they are going to be getting that contribution. It would be contribution with donor restriction. Question?
The beneficiary, I guess is what you would call it, is using accrual accounting as well, right? So they're going to debit that receivable on the day of the donation to the United Way, correct?
Everybody's using accrual accounting
Gotcha.
for not-for-profit. And so I'm not sure that I'm connecting those two for your question, but because they're going to be receiving that on the day that they're notified, which would, pretty much be for accounting purposes, the same period in which the contribution was received, yeah, they set that up at that time.
Gotcha.
Okay. Okay, good. Now, going over, we didn't talk about investments, or did we? We did not, right? How to account for investments for not-for-profits. Okay. So when you look at a not-for-profit, just assume that everything's being treated as a trading security. Everything's being treated as a trading security. So what do? You mark it to market on the balance sheet, and any unrealized holding gains and losses go directly to, and we don't call it the income statement, we call it the statement of activities. Okay, that's the key thing there with investments. Everything is carried at fair value, balance sheet. Unrealized holding gains and losses are treated as are reported, I should say, on the income statement of activities. Okay, all right, good. Coming over other accounting issues, the only other thing was split interest agreements, which I do know we covered that last time. We went through these slides last time with the split interest agreements. Question? Okay, good. If there are no questions, then what I want to do is pick up one other thing we kind of went through, and I think you can see the similarities talking about recipient accounting versus beneficiary accounting, et cetera. But I want to look right here at financially interrelated organizations. And I want to go ahead and put it in tablet mode. Okay, good. Let's see if I can put it in full screen. Okay, good. So let's take a look at financially interrelated organizations. Okay, so what happens? Well, now we have the situation where there's a foundation that is raising money for the benefit of an entity that essentially created the foundation. It's a captive entity. And so if that's the case, the recipient, the foundation, will recognize a contribution. But what gets weird is the entity that is receiving that money will recognize that ultimately would ultimately receive that money. The beneficiary would debit an asset because now there's been a contribution that is going to accrue to their benefit. And rather than run that through the statement of activities, it is a direct credit to the net assets of the entity, and it is titled as change in interest in the recipient's net assets. And so you can see that journal entry right there that would be made in that situation. But let's just go ahead and let's look at this fact pattern for financially related entities. Okay, so you have Farley State University, a private not-for-profit institution of higher learning, established Farley State Foundation, a not-for-profit corporation, to raise funds for the university to account for and manage the investments of the university. The university foundation are financially related. During the current year, there was 25 million that went to the foundation, and they asked for the journal entry for both the foundation and the foundation. Foundation treats that as a contribution. There's a debit to an asset, the interest in the foundation's net assets, and then there's a credit to change in interest in net assets. It's going to be a direct credit that will go to the net assets of the beneficiary, in this case, the university. And that's because the state foundation really has no option as to how they're going to distribute those funds. They have to give it to the university.
Question. So does it show up on the statement of activities for the foundation, but not the university?
Correct. It's going to increase the net assets of the foundation, but I mean of the university, but it's going to show, it's not going to be listed as any kind of contribution. It's going to be shown as a separate line item, increasing the net assets of the foundation, of the university, excuse me.
Okay.
So so the interest part that debits net assets too? So it's like total net assets, the 25 million is a net zero?
No. No, that debit to interest in SF net assets is an asset account.
Oh, okay.
And the change in interest in FSF's net assets is a credit to the net assets.
Got it.
Think of it like an OCI entry almost.
Okay.
Okay, all right, take a look at this question. I think that'll help to clear up this last point that we just talked about, and then we'll look at two more multiple choice questions dealing with how to account for, account for investments. But let's just take a look, and I'm gonna let you try this one on your own. See, I think you'll see it's not that difficult. Okay, guys, let's go ahead and do this one. I think I screwed you up here a little bit, in all honesty. C is the correct answer, and I think why some of you probably picked B, because I did sort of make it sound like it would be on the balance sheet. I understand why I'm picking B, but that increase, my point was, it's not shown as a contribution. It's shown like an OCI item on the statement of activities. So I apologize for making that a little unclear. Most of us got it right, but the correct answer here is C. Okay. Okay, good. Let's go ahead then and let's turn our attention here to a couple more questions. Other accounting issues. I'm not going through this right now, primarily because we talked about how to handle financial instruments. Okay, but let's go ahead in those slides that we just looked at. Okay, but let's look at endowment funds. Okay. And when we look at endowment funds, we have board designated endowment funds versus donor restricted endowment funds, which they tell us is the most common. But board designated endowment funds are created by not-for-profit entities governing board by designating a portion of net assets without donor restrictions. So the key thing there is don't get tricked in. And I asked you to flashcard this before. If the board of directors makes a designation as to any funds, those are still considered what? Without donor restrictions. Okay. An endowment fund created by donor stipulation will be considered what? Will be considered donor restricted. Okay, so it kind of sounds like, okay, no duh, right? Okay, but I just want to make sure that we are covering that as it relates to endowments. Endowments basically go on in perpetuity, right? Okay. A not-for-profit organization reported endowment fund in its financial statements position in one of the following two classes: net assets with donor restrictions, or what? Net assets without donor restrictions, depending on whether or not, of course, there's been a donor restriction. Let me go ahead. I think I forgot to end the poll. Or stop sharing the poll anyway. Okay, all right, good. Now we come over and let's take a look at board designated or specific issues regarding changing the value of donor restricted endowments. And at inception, the original gift and amount related shall be classified as net asset with donor restrictions. And then unless a purpose of the donor restriction exists on the use of income, investment income is deemed available for spending and is classified as net assets without donor restrictions, which is a little annoying because they almost argue with themselves in the same paragraph. They say, well, if there's no donor restriction as to the use of earnings, then it's without donor restriction. But then if there is a restriction from the donor as to the use of the earnings, then the earning would be considered with donor restrictions. So it's not like a one rule there that we're trying to flashcard, but do flashcard that and then just remember that the opposite is true. If they do specify a donor restriction, then it would be with for the earnings, and it would be with donor restrictions. Investment subject to restriction by donor by law shall be reported with as net assets with donor restrictions until appropriate for expenditure, meaning that the donor has said, hey, you have to accumulate so much of this from earnings until you can begin to spend out, something like that, whatever it is. Okay, because sometimes they'll put that kind of restriction on there. Now, you come over, and one of the things that is relatively new to the requirements that I don't know that the examiners will get this detail, but Becker, just trying to be very thorough in how they go through these things, included some recent pronouncements on how to deal with underwater endowments. So what happens? They sit there and the donor gives a certain amount, and they tell you have to maintain this value. And then over a period of time, the value of the stock drops. Well, now you have what? You have potentially underwater endowment, right? They contributed originally $1 million, but now the stock is worth 800,000. That would be an example, has a fair value of 800,000. That would be example of an underwater endowment. And let's just look at the disclosures that are required and go ahead and flashcard that. We'd have to disclose the fair value of the underwater endowment, the original amount, and the amount of deficiency that's there. And they've given us a mnemonic for that, Fed, which I guess is somewhat helpful. I don't know if there's a federal statute that govern these kind of disclosures for not-for-profits or not. So that's a little confusing, but they're not going to ask you what level of statute maybe brought on this. FASB is requiring this disclosure, whatever the reason. And so it's worthwhile to flashcard that. And so they give us an example of, an endowment gift that had a fair value of 9,750. The original donor's gift was 10 million. And now we have this, underwater deficiency amount of 250. Okay. All right, good. Let's take a look at a couple more questions, and then we're going to get into governmental accounting. Okay, guys, I'm going to go ahead and end the poll here. So take your best shot. Okay. And yeah, okay, good. We got a good 90% on that one. Investments are carried at what? Carried on the balance sheet at fair value at the date of the balance sheet. Okay. It doesn't matter what the donor's basis was. Doesn't matter what it was at the time that we received the contribution. At the date of the balance sheet, we report the fair value at that date. Unrealized holding gains and losses go through the statement of activity. So A is the correct answer. Okay. Okay, good. Let's go ahead and let's take a look at the next one. Okay, let's go ahead. Looks like everyone's had a chance to try this one. And okay, good. Most of us got it right. The answer here is D. Let's go ahead and let's go through this one together, though. RST charities receive equity securities valued at 100,000 as a gift without donor restrictions. Okay, so what would happen? Debit the security, credit contribution without donor restrictions. Statement of activities is going to show what? A without donor restriction contribution in the without donor restriction column, obviously, on the statement of activities. During year one, RST received 5,000 in dividends from these securities. Debit the cash, credit what? Credit investment earnings, and they're not telling me anything's restricted here, so I would show that in the unrestricted column on the statement of activities. And then at year end, the securities had a fair value of 110. Well, if they're originally at 100,000 and we've had a 10,000 increase, debit the security to report it at fair value on the balance sheet, credit what? Gain from, and it's going to be showing in the without donor restriction column, because again, they haven't specified any restrictions on increases in value or any earnings or dividends received from this. And frankly, it doesn't matter because the question asked what is the effect on net assets, and didn't try to tease out whether it was with or without donor restriction. So you didn't really need to worry about that, but from reading this question, it looks to me like this would have all increased without donor restriction contributions. Contribution and investment earnings. Okay. Okay, good. Hopefully you were getting those correct because you're understanding some of this not-for-profit material and you had a chance to look at some of that stuff from last time that probably helping you to get comfortable with the way this information is being presented. You know, it used to be a little easier to call out the number of points for not-for-profit, but now they have buried that in with the for-profit information. So it's a little harder to, you know, really get a sense of the points. Anecdotally, though, students are frequently saying, hey, I was surprised there was that much. And the comment is always governmental and not-for-profit. I think they really mean more the governmental, but since Becker presents them together, they tend to lump those two together. So I would say you can guarantee you're going to have 5 to 10 points maybe of not-for-profit. Okay, for governmental, because in the blueprint for the exam they explicitly call out governmental, we can pretty definitively say that you can have between 15 and 20 points of government. Okay, 15 to 20 points of government. Okay, so I'm pointing that out, and part of the reason, I forget, I think it might have been Shannon had suggested that that's why with our limited time left, we make sure and get a good coverage of this. And I'm hearing more and more through the social media and stuff that government is causing students some trouble. Okay, so we need to make sure that we are comfortable with this stuff. So we're going to pretty much be spending the next couple of classes making sure that we get a good start and get into this stuff. Okay. Okay, good. So just keep that in mind, guys, because I think there is a tendency, because it's towards the end of the class, the end of the book, to discount this idea about the governmental accounting. Don't make that mistake. That's a surefire way to fail the FAR exam. Okay. All right, good. So let's just go ahead and let's take a look at what are the objectives of governmental accounting. Okay. And so when we look, we are talking about service mission organizations, which is essentially government, okay, to easily monitor and report compliance with spending purposes, which is fund restrictions, and spending limits, which is budgets, okay? So let's just go ahead and take a look. When we say budgetary, we mentioned the budget here, spending limits, okay? Let's just go ahead and put over here as an objective budgetary control. And I'm having you write that phrase in there, budgetary control, because the exam might use that kind of word as an objective, okay? Making sure that we're within spending limits. Example, budgetary control, okay? When we talk about reporting compliance, okay, compliance with what? Compliance with legal restrictions is another objective that you might see. Okay, so just giving you some, what the hell happened here? Just giving you some additional wording here. Spending purpose, fund restrictions, spending limits, budget, but I'm adding in the notion of legal restrictions, budgetary control, okay? Now, those are just words, right, that I have to have you flashcards, so you really recognize those as buzzwords when you see them in questions, that these are the kinds of things that we're trying to achieve with our governmental fund accounting, okay? But let's just go ahead and let's put this into some sort of, example that might be a little easier to digest, okay, than all those words. And I like to always start out with my attempt at art here. What is this?
That a road?
Beautiful. See my artistic ability, okay? Now what happens? We sit here and let's say the legislature passes a law that says that they're going to put a tax on gasoline and that gas tax will be used for road improvement, okay? And because they don't want this government to, spend the money in a haphazard manner, they say, you're only gonna be able to spend $5 million a year. Okay, because they want a little bit of budgetary control on that. So what happens? Well, meeting our objectives, we would set up a fund, and the fund would account for the gas tax. And we're going to get into the names of the funds here in a little while, but we would probably call this gas fund a special revenue fund. The revenue is what? The gas tax. The spending of the money is spending it on road improvement. So we'd be what? Looking at reporting on compliance, legal restrictions. Did they really spend the money on road improvement? And then the second point would be, did they spend, just, I forget what I said now, the 10 million a year, whatever it is, right? So that would be more the budgetary control, spending limits. Okay. Okay, so that's the objectives of what we're doing. And so because that's the case, we're going to sort of have to learn some things about budgetary accounting and how not-for-profits present the information so that we can see that we spent amounts that we were appropriated, given by, legislation, as, in compliance with legal restrictions and within budgetary control. Okay, so let's go over and make sure that we understand when we talk about governmental units, that for the CPA exam, we're talking about state and local governments only. State and local governments, okay? No federal government, okay? So I'm not trying to be, Alex Jones or one of those people when I cross out the federal government, okay? I'm just saying to you that, no federal government accounting on the CPA exam. Federal government accounting is highly specialized. It is governed by accounting standards established by the Federal Accounting Standards Advisory Board. FASAP standards are not tested on the CPA exam. It's only state and local government accounting that we're going to be talking about, okay? So what entity sets the standards for state and local government accounting? And that's going to be the Governmental Accounting Standards Board, the GASB, which is essentially the sister brother agency, whatever, of the FASB. They really exist in the same building. The only difference is if you go visit FASB, 90% of the building is taken up by FASB. GASB's like one little, corner of the office over there, but they are part of the same foundation. But the GASB sets the most authoritative standards. Again, I don't know that you need to write this, but I want to emphasize it's state and local governments. No federal government accounting on the CPA exam. Okay, good. Now, the good news is all state and local governments use the same requirements. So it's not like, well, if you're dealing with the state, you got to do this. If you're dealing with the city, you got to do that. If you're dealing with the county, you got to do this. All levels of state and local government use what we're talking about in here. Okay, good. Now you come over and you take a look at the information that you will see, and GASB has jurisdiction over what goes into the basic financial statements and required supplemental information. For example, if a not-for-profit uses certain depreciation methods as an option to the required option, they have to provide you information as part of their required supplemental information. We'll talk about that more in F10, okay? But right now, F10. But right now, just focus on the GASB sets the accounting standards for financial statements and required supplemental information. Now, what happens? Not-for-profits also prepare an annual report, okay? Only they call it a comprehensive annual report. They used to use the term CAFR to describe that, but they're getting away from that abbreviation now. So it is comprehensive annual financial report, but it is not the GASB that tells us how to prepare this information. It is the GFOA, which is the Government Finance Officers Association. And they have, maybe at the break, if somebody reminds me, I'll hold up that big old blue book where they go through and they tell you all kinds of other things that you have to put into your financial reports, okay? But that is not the financial statements. Financial statements are really just a piece of that overall comprehensive annual financial report. We'll get more into that, as I said, in F10, okay? All right, good. Now, let's just go over and let's take a look at a couple things. I want to go past some of this stuff because it's not very useful. And frankly, I'm afraid of some of it, like that picture. Okay, so I want to go past that picture because I have a rodent fear. Okay, and it doesn't help you at all. Okay, so let's not creep ourselves out by looking at that. Okay, now if you come over, okay, and we talk about the external reporting. Okay, just come over to that page, wherever that's at now. What page? We're on page 49 now. Okay, so just come over to page 49. Okay, and let's look at this notion of external reporting. Okay, and this gets a little annoying because everything we're talking about here is external reporting. This is what we're talking about: financial accounting and reporting. We're not getting into internal budgetary accounts of a government entity. So we're talking about what they prepare, and GASB establishes minimum reporting requirements to be in compliance with GAAP. Okay, and they tell us that reporting requirements include both fund-based and government-wide financial statement presentations. Now, again, we're going to get into more of the government-wide stuff in F10. Okay. Okay, but F8, F9 is going to be dealing more with the fund-based stuff, the rest of F8 and F9. Okay, so let's just come over And I'm going to draw you, and we'll come back to that question in a second, but I just want to draw you a quick little picture, okay, to illustrate what we're doing. Okay, so you have what? You have various categories of your fund financial statements. You have something called governmental funds. You have something called proprietary funds. Okay, and you have something called fiduciary funds. Okay, I probably don't have to write funds every time. Okay, now, when we look at the governmental funds, there are 5 of them. 1, 2, 3, 4, 5. This is not a graveyard. Okay, these are the funds, governmental funds. Okay, we have 2 proprietary funds, and we have 4 fiduciary funds. Okay, and I'm not going to get into the names of these funds now because we're going to look at this in a second. This is just a high level discussion, and we report them. We have a financial statement for every one of these funds. We have a series of financial statements. We have a balance sheet and income statement essentially for every single one of these funds. Okay, now what happens when you come over? We also have government-wide statements. Okay, and what happens in these government-wide statements, okay, is they take the information from these funds and they consolidate them at the government-wide level. So just like you would have company A and company B, and you would consolidate company A and company B if they're under the same ownership into one set of consolidated financial statements, like we learned back in whatever it was, F4. Okay, well here, what we're doing is we're taking the individual fund statements and consolidating them up into a set of government-wide statements. Unlike with a for-profit entity where maybe you won't see all the pieces that make up those pieces, those subsidiaries that make up the consolidated. For government, you will see the pieces. You will see the fund financial statements and you will see the consolidation, and we are going to have to provide some information that's going to allow you to be able to see how those 2 pieces connect. We're going to spend most of our time and most of those, what did I say, 15 to 20 points, whatever. Most of those points will be on the fund statements. We're going to cover that in F8, F9. And then, as I said, for the government-wide, we'll cover that in F10. That tends to be a smaller portion of the points. And in my opinion, Becker overkills on what they give you in that. So we'll probably have to squeeze in pretty quickly to the end some of that F10 stuff, because they really go on and on, because the person that puts this information together, who I consider a friend, needs to get a life. And so he tends to just be way too thorough for our purposes here. So we'll spend most of our time with F8, F9. Tom's a wonderful guy. His mom lived to be 100 years old. And so he's comes from, long-lived genes. So he's got a lot of long time to keep writing this stuff. We don't have that long to understand it all, though. So we're going to go ahead and understand the key points here as we go through this stuff.
Did you?
Quick question. The comprehensive annual financial reporting that you showed in the little box over on page F845, is that the government-wide reporting? Or is government-wide reporting something different?
Well, think of it as the annual report. So when you look at the annual report of, say, a for-profit entity, right, there's all kinds of information in there.
Oh, okay.
The financial statements are
just part of it. Got it.
Right?
Okay.
And so
Sorry.
what we're talking about here, Kathy, is that financial statement part of the bigger piece, which is the comprehensive annual financial report. So you'd kind of do one of these. This is the comprehensive annual report.
Got it. Thank you for the clarification.
They used to call it a CAFR, and it turns out that that's a racial slur in South Africa, so we don't use that anymore. So if I do mistakenly say that, I apologize in advance. It's a comprehensive annual financial report, and the annual report contains the financial statements as well as there's an MD&A in there, and we'll get into that more in F10. Matthew?
Yeah, when you circled the fund financial statements, did you intentionally leave the fiduciary funds out of that circle, or?
I did, my friend. You weren't supposed to catch that. I did intentionally because it turns out that the fiduciary funds are not consolidated up, but I don't want to get into that right now. But I did it on purpose.
Gotcha.
Just accept that for now, and I'm going to explain to you why. I can tell you now. I'm just trying not to overwhelm everybody at once. But when we consolidate up, we have two columns. One is called governmental funds, and the other is called, or not governmental funds, but government activities. So there are two columns on the consolidated statements. One is called government activities and one is called business activities. And what they do is they take the 5 governmental funds plus 1 of the proprietary funds, and they consolidate them under governmental activities. And then they take one of the other proprietary funds and put it under business activities. And the fiduciary funds, it turns out, are not consolidated up. Okay. All right. But that's a little ahead, but we will get to that. Okay. So that's a good observation. Okay, good. So with all that, let's not quite related to what we just talked about, but we did cover this a little bit. So let's look in some of the earlier pages here for the government stuff. So let's go ahead and take a look at this first question related to government. Okay, good. Looks like everyone's had a chance to try this one. So let's just go ahead and save a little time and take a look. And yeah, we got a good 90%. Looks like maybe the fact that I called it budgetary control when we were looking at it might have thrown a couple folks off. Budgetary control, financial control. The word control is the key word in those phrases. Is something that we're trying to achieve with governmental accounting, and then fund accounting. And we said, that I think I explicitly called out legal restrictions.
Yeah, that's exactly what caught me, is the budgetary versus financial.
Yeah, that might have been something that's tricky, but the key word is control. Financial, budgetary, accounting, control is what we're trying to achieve here. Okay. Okay, good. Did we spend what, $1 million on road improvement? Just kind of keep that example in mind is what we're trying to achieve with the fund accounting. All right. All right. Now, as I've stated, we're really not going to talk much more about government-wide, till we get to F10. There'll be some to kind of throw some tissue paper at it every now and then, just to keep in your mind that it's out there. But what we're really going to dig in is dealing with the fund accounting. That bottom tier where we saw what? We saw 3 categories. That little picture I drew. We have 3 categories and we have what? 11 funds, 5 governmental, 2 proprietary, and 4 fiduciary. Is that 11? Yeah. Okay. So we have 11 funds. Okay. And what we're going to do is talk about each one of these, spending most of the rest of the evening focusing, in fact, all of the rest of the evening, focusing on governmental funds. And then when we come back and we finish up F9, we'll talk about the proprietary, the fiduciary funds a little more. Okay. All right, but let's just go ahead and start with the discussion of the governmental funds, okay? And governmental funds use something called modified accrual accounting and the current financial resources measurement focus. Now, what the heck does that mean, okay? Well, when you decided you wanted to be an accountant back when you were 2, and you saw somebody, you know, all struggling, you know, on their way to work, and you say, oh, what does that person do? That looks like so much fun. And your mom said, well, that's an accountant. And you said, oh, mommy, that looks like so much fun. That's what I want to do when I grow up. That looks like so much fun. And your mom said, okay, but promise you'll always use full accrual accounting. You said, oh, I promise my mom. What's full accrual accounting? Okay, so full accrual accounting is what? If I purchase an asset, like a piece of equipment, what do? I debit equipment, say for $1,000, I credit cash. So you've known that for a long time, right? That's accrual accounting, okay? Now, what modified accrual accounting says is you don't have to use full accrual accounting. Who told you to do that? Your mommy, okay? For the governmental funds, we can use modified accrual accounting. So let's just go back to that road, and we're spending money on road improvement, and we buy a steamroller. What's a steamroller? It's a tractor with a big wheel on the front of it that flattens the road bed. Okay, so we're spending money, we're spending it on what? Road improvement. So we can accomplish our accounting objective here by what? By debiting expenditure. And crediting cash for that purchase of that piece of equipment. That's following modified accrual accounting. We don't have to keep track of assets and depreciation of assets and all that, because we just want to show that we spent the money for the intended purpose, which was what? Road improvement in this case. Okay, so what happens? Your job is to get comfortable with the handful of differences between modified accrual accounting and full accrual accounting. You're going to be about 90% of the way there to those 15 points. So it turns out that governmental accounting, instead of what we see all over the place, oh, governmental accounting, it's going to be your ace card. It's going to be your trump card. You are going to do better than 90% of the candidates out there on the government and not-for-profit, because you're going to focus on some of these key differences between modified accrual and full accrual accounting. This one that I'm showing to you right now being one of the classic examples, and you're going to do very, very well in this area. Okay. All right. So, but we've got some work to do to get comfortable with some of the key differences. And one of the frequent questions you see, when I say frequent, you know, of those 15, 20 points, maybe you'll get 5 points. Just asking you, do you know the names of the funds that fall into the 3 categories? Okay, so for our governmental funds, we have, and this is one of the few mnemonics I do believe in the course, which is GRASP. Okay, GRSPP. Helps you to remember the names of the governmental funds. GRASP, GRSPP. Actually, don't worry about flashcarding that yet. I'm going to show you where I want you to make your flashcard, but do fill in those bubbles. That is the mnemonic GRSPP. That spells grasp. And some people say, no, it doesn't. Well, yes, it does. Okay, so that spells grasp. Okay, those are the governmental funds. So they may say to you, which of the following funds uses modified accrual accounting? Internal Service Fund, Special Revenue Fund, Custodial Fund, Investment Trust Fund. What's the answer?
Special revenue.
Special Revenue Fund, because you remember that is the R in grasp. Good. Easy points on the CPA exam. Takes you 2 seconds to answer that question. Okay, good. Let's go ahead and let's take a look at the structure of the governmental fund. And there are 2 statements that are prepared by the governmental fund: the balance sheet and the statement of revenues, expenditures, and changes in fund balance. Okay, now the balance sheet is, of course, like the balance sheet. The statement of revenues, expenditures, and changes in fund balance is like the income statement, but we don't call it that. We call it the statement of revenues, expenditures, and changes in fund balance. Okay, now when we look at the balance sheet, and I want you to flashcard the structure of the balance sheet, and I want you to mark this up the way I'm showing you right now. We have what? We have current assets and we have current liabilities, current items only. Look what happens when we purchase a long-term item like a piece of equipment, like a fixed asset. What do? We debit what? Expenditure, don't we? We don't debit equipment. So there's no account there that's going to allow us to what? To debit fixed assets, because we don't have any. So it's only current items, current assets, current liabilities. Okay. Now, when you come down, they say that you report your current assets, current liabilities, and then you'll have to report your fund balance. And next to fund balance, I want you to put like retained earnings. Now, sometimes I hear folks say, well, the fund balance is like the equity of the governmental entity, the state, the city, whatever. But I don't like that analogy, because governments don't issue stock, do they? No, you can't buy stock in the city of Stockton or Hayward or whatever. You can buy their bonds, but you can't, but they don't issue stock. Now, I don't know, maybe someday, if we get another president like some that we've had, they'll want to start selling stock to the United States or something. But right now, we don't have we don't have stock being sold. We have liabilities that are sold, but not stocks. Okay, so really, when you get to the equity section, just think of that as fund balance. I mean, excuse me, it is called fund balance, but think of it as retained earnings. It's like retained earnings. Okay, now, when you look, notice they say, well, you have to add up your assets, your liabilities, and your fund balance, and you have to report that as a total. Okay, so you have your total current liabilities, total of your fund balance, and that, of course, is going to balance to your assets, right? So if my assets are $100, and I'm not trying to insult anyone's intelligence, that equals what? Liabilities, say, of $40, and my owner's equity, I'll just call it stockholders' equity. My stockholders' equity would be how much in that case?
60.
60. Okay. Yeah, thank you. So all I'm saying here is this total in this case would be what? Would be 100. You'd add the liabilities and the stockholders' equity together so that totals up to the assets. Okay. That is the required format. That's how our governmental funds are required to report their information. They show their assets, although all current. They show their liabilities, although all current. They add the fund balance to the current liabilities. Fund balance is like retained earnings, and that needs to total up to the assets. With me so far? Okay. Now, notice there were a couple other things mentioned here: deferred outflows, deferred inflows. Okay. And what I want you to put down here is deferred outflows are like LIKE prepaids, but not quite, because prepaids are assets. But think about it. A prepaid is what? You spent some money, you had an amount flow out, and the benefit's coming later, isn't it? Okay, so what happens? A deferred outflow is sort of like a prepaid, but not quite. A deferred inflow is sort of like a deferred, put the word like deferred revenue, but not quite. That says like deferred revenue, but not quite. Okay. Now, what I want to do, and we're going to get more into this in some detail tonight, but what I want to do is just show you sort of a silly little picture here of that's on e-learning with some of these slides that just gives you a silly little sense of the difference between a deferred inflow and a true liability. Okay, so what happens if a not-for-profit collects revenue in advance and it has not met the eligibility, not edibility, but eligibility requirements for that money? It is a liability, and it is called a revenue collected in advance or an unearned revenue. You can't call it deferred revenue because they saved the D word. They saved deferred for deferred inflow. Now, what happens? Once a government has met eligibility requirements, but there are still some timing issues that they have to meet in order to treat that entirely as a revenue, that's when something evolves from a liability to a deferred inflow. And FASB felt that it was worthwhile to call those out as a separate line item from the liabilities. We put them next to the liabilities because they're not ready to hit the statement of revenues, expenditures, and change in fund balance yet because they're not a revenue. It's not until a resource inflow has met both eligibility and time that we can then turn it into revenue. In other words, it goes through the entire stages now. It's a butterfly, okay, or a moth, or whatever the hell this thing is, okay? All right, so just keep that in mind right now, guys, and we're going to talk more about this, so I don't need a full understanding of it. I'm just showing you that visual so you can understand why we put deferred inflow next to the liabilities, but they're not a liability. And we put the deferred outflow next to the current assets, even though they're not a prepaid, but they are similar, okay? Okay, so required format, current assets equal what? Current liabilities plus fund balance. That's the big picture. And you have to report the total of your current liabilities and your fund balance to match. So it's a true balance sheet, right? To match the amount of current assets. Okay. Now you look at revenues, you look at the statement of changes, the statement of revenues, expenditures, and changes in fund balance. You have revenues, you have expenditures, you have other financing sources, you have other financing uses. Other financing sources, guys, put down are like LIKE, non-operating revenue, okay, and other financing uses are like non-operating expenses, okay. Flashcard, the statement of revenues, expenditure, change in fund balance. Make sure you indicate it's like the income statement, and make the comment as to how other financing sources is like non-operating revenue, other financing uses is like non-operating expenses, and then include on your flashcard that the net change in fund balance is like NI. What's NI? Net income. Okay, but we don't call it net income. Okay. All right, good. Now let's go through a little exercise here. If change in fund balance is like net income, will revenues increase the net change in fund balance or decrease it? Increase it. Good. If net change in fund balance is like net income, will expenditures increase or decrease the net change in fund balance? Going to decrease it, right? Okay, good. If other financing sources are like non-operating revenue and change in fund balance is like net income, will other financing sources increase or decrease the change in fund balance?
Can you repeat the question?
Yeah, I think if, I don't know if I can repeat it exactly how I said it. If other financing sources are like non-operating revenue and the change in fund balance is like net income, will other financing sources increase or decrease the net change in fund balance?
Increase, right?
Increase, right. I mean, non-operating revenues increase retained earnings, don't they? Increase net income?
Yeah.
Okay, so if non-operating revenue increase net income, then and other financing sources are like non-operating revenue, then the other financing source is going to increase the change in fund balance, right? Am I not saying it right? Okay, if what? If other financing uses are like non-operating expenses, then are they going to increase or decrease the change in fund balance?
Should decrease it.
Decrease it, good. Okay. All right, guys, make sure you got that impact, the format, and then the impact of the various things on change in fund balance down, because they do like to ask that. Okay, good. Now, I had said that we'll get into the proprietary funds and the fiduciary funds in F9. But we are going to talk about the type of accounting that these other fund categories use. So remember, we've got the proprietary fund category. We've got what? We've got two funds in there. One is called the internal service fund. The other is called the enterprise fund. And we're building a mnemonic here, SE. Okay, so you can fill that in. Okay, but when we're talking about the proprietary fund, so that's those two boxes, those two little rectangles that I wrote under the proprietary fund category. Notice they're telling us that they use full accrual accounting, the economic resources measurement focus, which is what you've been using since you were 2. You've been using the full accrual accounting since you studied accounting. You've been using full accrual. So when we get to these funds, that's going to be pretty easy for us because they're using the accounting we've known for a long, long time, aren't they? Okay. Now, let's just look at the nature of an internal service fund. And they're set up to account for goods services provided by designated departments on a cost reimbursement fee basis to other departments and agencies within a governmental unit or to other governmental units. And the classic example is a motor pool. So what happens? You sit there and, do cities own vehicles? Let's hope you don't have one behind you tomorrow while you're coming home from work, which is a police car, right? Fire trucks, whatever, are all city-owned vehicles. Well, look, they don't want to take those all down to the local garage. So they have a central motor pool where all the city buses, fire trucks, police cars all get worked on, right? So you say, wow, I'm going to take my car there. And you drive up your car to get it worked on in the motor pool. What are they going to tell you? Out. We only work on what? City-owned vehicles here, right? Okay. Well, that activity is sort of like a business going on inside of the government. Now, they don't have a profit margin there. They're just trying to cover their costs, but that activity certainly justifies the use of what? Of full accrual accounting, since it's like a business. Okay. Now you come over and you take a look at enterprise funds, okay? And note that enterprise funds now, they're set up to account for the acquisition operation of government facilities, services that are intended to be primarily more than 50% self-supported. And the key phrase here is user charges and fees, okay? And the classic example here, that says fees, the classic example here is what? The water and sewer utilities. So what happens? Let's say you're getting ready to go out on a Friday night and you decide you better wash your hair before you go out, okay? You guys have this problem, I don't. So what happens? You sit there and all of a sudden they cut off the water while you're washing your hair, and you say, help, turn it back on. I got soap in my eyes. What do they say? Pay the bill. They cut you off if you don't pay. Why? Because they need your fee to what? To be able to run that water facility. And I know we think that you just turn on a faucet and the water comes, and what happens? Meanwhile, there's people that are geniuses that we're leveraging off of that figured out how to get the water from Hetch Etchy up the hill, through Hayward, down the hill, back up the hill into your house, right? In San Francisco. So that's a costly endeavor. And so they charge fees to support that. Okay, and that's accounted for in an enterprise fund. Okay, so distinguishing factors of an enterprise fund is the activity is financed by debt secured by a pledge of fee revenue, or laws require the collection of fees to cover costs. So what's the key word? Fees, user charges to cover costs. Then we know we have an enterprise fund, right? Okay, good. So go ahead and flashcard the buzzwords here. The other one that you can add to this is you can add the pricing policies are established to cover fees, costs, but also add enterprise fund is financed by debt serviced by pledge of user fees. Okay, so that's very similar really to what we had up there in that first one. So I'm not sure why I'm asking you to write that again, but anyway, we're covered there by that flashcard, so just flashcard that. Okay, because sometimes it's a little hard. For example, is a lottery an enterprise fund?
Yeah, I would say so.
Yeah, they're financing that operation by the fools, I mean, by the people that decide to play that, right? Okay, what are the odds of winning the lottery?
Low.
49 million to 1. That means you put 49 million numbers into a bag and you're going to reach in and pick out the right number. Go ahead, I'll see you in hell by the time you pick that correct number. But anyway, but you know, some people say, I've heard people say, well, I don't mind because I get to dream all week while I'm waiting for the lottery numbers to come in. I'm like, okay. But anyway, all right. So let's,
Have to pay to play.
No, I guess you might win. I don't know. I don't see how, but I won one time. I won $100, and that was on a scratch-off ticket, and I'm determined to keep that 100. Okay, let's go ahead and let's take a look at a couple of other ones here. Okay, I'm not a gambler. I only gamble on one thing, which is baseball. And the reason I'll gamble on baseball when I'm in Vegas is because they do odds. They don't do point spreads. So with baseball, what they do is they'll say, well, here's the odds. And if it's pretty much an even money bet, I put up 100 to win 100, I'll bet on that because the ball is round and it can do whatever it wants. And it generally takes me 4 hours to lose my money. And so I feel like, okay, that's a worthwhile thing to do on Vegas. Other than that, I don't like to bet. Okay, so let's stop on that. Okay, so let's take a look now at the financial statements that are prepared by our proprietary funds. Okay, both our internal service fund and our enterprise fund prepare a statement of net position. Statement of net position is LIKE, like the balance sheet. Statement of revenues, expenses, and changes in fund net position is like LIKE. The income statement. Now, not shown here, okay. The proprietary funds are the only funds that also prepare a statement of cash flows. So they also prepare a statement of cash flows. Okay, but we're not going to get into that until later in F9. But do know, have in the back of your mind that they do prepare a statement of cash flows. Okay, now notice that what? It's all assets, all liabilities, current and non-current. Unlike the governmental funds, which reported, just the current assets and current liabilities, they report all assets, all liabilities. Like the governmental funds, they put the deferred inflows and outflows, line them up with the assets and liabilities, just like we do for the governmental funds. And then they report net position. Net position is like LIKE, the retained earnings of these proprietary funds. Okay, like retained earnings. Now, notice though that they're using a different format. If assets are 100 and that equals liabilities of 40, which is, and that means that my stockholders' equity would be 60, right? We talked about that a minute ago. Is it also true that if I were to take 100 minus 40, that difference would be 60? Okay, so notice that when I'm dealing with my format for my proprietary funds, they use the difference approach. They're reporting what? They're reporting assets of 100. They're subtracting the liabilities of 40 and showing the net position as the difference between those two. Okay. Now I want you to put that down, that is an optional format. They could do it the way we said for the governmental funds, but most proprietary funds are going to show it as the difference. The governmental funds must add up the liabilities and the fund balance to total to the assets. They must show that bottom line. Whereas for the proprietary funds, the bottom line is the difference. Okay. Now, flashcard, the format for the balance sheet, and flashcard, flashcard, the format for the statement of revenues, expenditures, and change fund balance. But I have a little tip for you. F1. Did we talk about the format for the income statement in F1? In which we said what? We said operating revenue, operating expenses, right? And then non-operating revenue, non-operating expenses. And then you had the change in net position, which is like what? Like net income for us. So we should be very, very comfortable with the accounting for our proprietary funds because it's using full accrual accounting, all assets, all liabilities on the balance sheet. When we get to the income statement, it's going to follow the same format that we learned for commercial entities. Okay.
Question, if this is the optional format, this is still the one we should learn for the test. They're not going to throw us a curveball and show us the other one and say, is this correct?
I think you should know that this is the optional format. And I think some things we just have to leave to an understanding that if you don't use the optional format, the only thing that's left is the
Got it.
Is the required format for
Governmental. Yeah.
the government funds. Yeah, governmental funds.
Got it. Okay, thanks.
Yeah. Okay. All right. Good. Now, fiduciary funds. Okay. Full accrual accounting, economic resources measurement focus. All I want you to understand about these funds right now, which are very lightly tested, is what are the 4 funds, right? There's 4 that fall into the fiduciary fund category: custodial fund, investment trust fund, private purpose trust fund, and then I don't always have trouble with the last one. I think it's POE, P-O-E. So what's that song? Well, you guys are too young to remember. Tiptoe Through the Tulips. There's a song. You ever heard of Tiny Tim? Had this song called Tiptoe Through the Tulips. Okay, well, ours is going to be Tiptoe Through the Tulips. Okay, and that's the extent of my falsetto tonight. Okay, all right. So at this point, just remember the names of those funds. We're not going to get into the nature of the activity until much later into F9. Okay. Now, the required format, Kathy. Okay. So what I'm really focusing on is whether it's required or optional. Okay. The required format for the statement of fiduciary net position, which is like the balance sheet, is, since we're full accrual accounting, all assets, all liabilities, but they take the difference approach. The difference between the assets and the liabilities report a net position, which is like retained earnings. So for the fiduciary funds, you are required to basically have as your bottom line your net position on your balance sheet, on your statement of fiduciary net position. Okay, the statement of changes in fiduciary net position is like the income statement. Okay, and additions are like revenues. Deductions are like what? Expenses. And change in net position is like net income. Okay, so flashcard these. Make sure you know the names of the statements, make sure you understand how they are analogous, and make sure you understand how the different formats are required or optional. Okay, all right, a couple things I want to do here before we take the break. And let's see, right now, I want you to put right here, see page 55. And I want you to come to page 55 with me, because notice we went through a lot about the different funds and the mnemonics that you can use. And I didn't ask you to flashcard that stuff. And the reason I didn't ask you to flashcard it is it's right here. Okay. Gives us all the key things that we kind of went through. And I said, well, don't flashcard it here because I'm going to have you flashcard it down here. Okay. So if we are dealing with our what? If we're dealing with our governmental funds, right? Our governmental funds. Okay, governmental funds right here. We use what? We use the modified accrual basis of accounting, current financial resources measurement focus. They give me the mnemonic and they give me what? The names of the funds, and they put and in there just to spell grasp a little bit better. Okay, but it's SPP, that's pronounced grasp. Okay, so that's your flashcard. Tells me right there, current financial resources measurement focus, modified accrual basis, gives me that it's the governmental fund category, right? And it reminds me of the mnemonic. So what you could do is just copy this page out of your text or clip it out of your text somehow and make your flashcard that way. Okay, or maybe you have a flashcard in your set of flashcards that came with your materials that you can just use for that purpose. Okay, now everybody else uses what? Economic resources, full accrual accounting. So CKITPO, okay, would be the mnemonic there. SE, CI, PP, P-O-E. And you can just remember that stupid song, go see Tiny Tim, go see Kip Coe through the tulips, okay? All right, so that's all right there for you. I think that's the key flashcards for you about the names of the funds and the type of accounting they use. And then make sure you're comfortable with the format for the required financial reports for those. Okay, good. So with all that, let's go ahead and let's take a break right now. And then we're going to dig more into what are some key things about the modified accrual basis and how it affects the funds. And then we're going to really start digging into that modified accrual basis for the governmental funds after the break. Okay, I'm going to pause. Somebody remind me, Matthew, to turn the recording back on when we come back. And I'll see you guys in 10 minutes. Let's see if I can get this to pause. I'm recording. Okay. All right, good. So let's just go back for a second now. We made those two flashcards, but just going back up, some key high-level differences between the different funds and the type of accounting they use. So for our governmental funds, right, with our mnemonic grasp, the A is for and. I wish they would just leave that A out of there because I've had a student one time complain to Becker telling them that I said nothing about the A fund. There was this guy, Ed Cordisco, who is now in the big CPA review course in the Sky. But they complained to him. He was the lead faculty for Becker. He sent me an email saying, I thought you'd get a kick out of this email, John. And he sends me the email because the student was mad because I didn't talk about the A fund. That's for and, but we have general fund, special revenue fund is the R, debt service fund, capital project fund, right? And again, under the current financial resources measurement focus, no long-term items. No fixed assets, no long-term liabilities. Okay. All right, good. Now, when we are looking at the economic resources measurement focus, which is used by the remainder of our funds, both proprietary funds and the 4 fiduciary funds, yeah, since they're on full accrual, they will report fixed assets, they will report non-current liabilities. Okay. Now, when we look at basis of accounting for modified accrual, we say revenue is recognized when measurable and available. Okay, measurable means that they can actually quantify the amount. Okay, in other words, they know that they're going to, that they've collected so much in taxes, but they know that they're going to have to do what? Put some refunds back. So they would have to adjust their revenue number for any kind of refunds. That's the measurable. The more interesting is the available. Okay, so under modified accrual basis, available means that it will be available within time to finance expenses of the current period, which is generally 60 days, but be careful because sometimes students just want to memorize 60 days. You have to read the question. If they tell us that 30 days is what the entity used, then any amounts that will be collected within 30 days can be counted as revenue. Any amount that can be collected in 90 days would be counted as revenue. So it gets a little bit funky in here in that you can't just rely on this 60 days. And then it turns out that there's more to understand here than just 60, 30, 90 days, whatever. There are revenue recognition rules that we're going to get into here pretty quick that are a little bit about as hard as it gets for the governmental. They're a little bit tough to understand at first, but once you look at them for a while, they're not too bad. And it turns out that they go by category of revenue. And that's really where we're going to have to focus. But it's not bad to have in your mind, hey, 60 days is something that I could often see in questions that are called out as the term for available. And if the funds are going to be collectible within 60, 30, 60, 90 days, you have to read the question, see if they tell you. But 60 is often used, then that would be considered a revenue in using modified accrual accounting. Okay. Also, expenditures are generally recorded when the fund liability is incurred, but there are exceptions, most notably, okay, debt service expenditures, both principal and interest, are not recognized until either due or paid. Okay, now go ahead and flashcard that, okay, with the interest discussion included as a specific example of that requirement. But let me give you an example. Let's say they tell you the city of Hayward issued bonds on January 1st, and it's a 3% bond, and interest is due every January 1st thereafter. At December 31st in the year of issue, how much interest should Hayward accrue? In other words, how much should they debit to interest expense and credit interest payable? 100,000, 3%. What's 3% of 100,000?
30.
30,000?
Mhm.
No, 3% is 3,000. 30% would be 30,000. So 3% should be 3,000, right? I'm missing something? 30% would be 30,000. Okay. Okay, good. So it's 3,000. How much of that should they accrue? They issued the bond December 1st. I mean, they issued the bond January 1st.
It's not due until January 1st.
Correct.
So zero.
So the answer is 0. But if I was asking you this for a full accrual accounting, what would be the answer?
3,000.
Okay, good. That's all I wanted you to know. Okay, so you don't accrue the interest at the end of the year, right? It would be 0 would be the answer to that question. Okay, I mean, okay, I guess you're understanding that, which is great, but you should be having excitement because that's a 2-second question on the exam. You know the answer is 0, and 0 will be down there in the D position, and then they'll make it even worse by having the bond issued, you know, December 1st or something. So you start thinking you have to calculate partial accrual. The answer is 0 there. Okay, okay, good. Now you come over, and if we're talking about the other funds, which is full accrual, as you know, for a long time, revenue is recognized when earned, expenses are recognized when incurred. So let me ask you this. What if it was an enterprise fund that did this? Issued a bond at 3% interest on January 1st. What would be the answer to that same question?
3,000.
3,000, good. Okay, good. Come over. We went and looked at that. So now we put a flashcard on some of that stuff. So let's go ahead and let's look at some multiple choice questions. Okay, guys, I'm going to go ahead. I have a sense that some people never came back from the break or something, but this is a pretty easy question, and you all got it right that attempted it anyway. And you will get questions just this basic on the exam. Okay, they just want to see, did you bother to crack the book on governmental accounting? So I think where a lot of the folks have problems in this area is they really they don't treat it as important. They don't spend as much time on it as they do with some of the other chapters. Meanwhile, you get much more return for your investment, in my opinion, on studying the governmental in some of those other chapters, although you have to study all of them, but still, don't discount this stuff because you get easy questions like this if you spend the time with it. Now, one thing I'd say, a question like this is answered just by remembering GRASP. Because if you remember GRASP, and that's modified accrual, then you know the funds here that are listed that fall into the GRASP mnemonic, and the internal service fund does not. It uses full accrual. Okay, good. Let's take a look at the next one. Okay, looks like most of you have had a chance with this one, so I'm just going to call it early since we're always searching for time here. So most of us got it right. The question asks which one uses current financial resources, modified accrual. Well, that's only what? Only the governmental funds. Okay, other fund categories use full accrual, economic resources, measurement focus. Okay, good. So let's go ahead and, so the answer is C, most everybody got it right. Okay, so now what we're going to do is start to dig in and talk more about the specific accounting for the governmental funds. So this is where probably most of the concern about governmental comes from, and that we're going to have to understand the differences between full accrual and modified accrual, but we're also going to have to understand something about budgetary accounting, okay? But once you get used to this budgetary accounting, it's not nearly as bad. But when we're talking about the governmental funds, we're talking about the GRASP funds, right? General fund, special revenue fund, debt service fund, capital project fund. Now, we come down and we talk about three differences between for-profit and governmental, okay? Now, we're going to have to learn something about the budgetary accounting entries, okay? All entities have budgets, but the government is a little different. The government's a little, I feel like I keep disappearing off the edge of the screen here. The government is a little different because the budgetary journal entries are standardized. The GFOA calls out what the budgetary entries should look like. And if something is standardized, it is testable. So all entities have budget, but generally budget requirements aren't standardized. For the government, it is. So we're going to have to study that. We're going to have to study encumbrance accounting. This is something that is unique to governments because they have to record purchase orders. Most entities, just because you order something, you don't make a formal journal entry. For government, state, and local, yes, you must make a journal entry. So we're going to have to get comfortable with that. Now, we're also going to be looking at actual activity. Okay, and the thing that makes actual activity challenging for a lot of folks on the exam, okay, and I put green for the encumbrances and the budgetary, because encumbrance is a budgetary activity. But for the actual activity, when we actually have a transaction, we're going to have to understand what differences between full accrual and modified accrual, and probably the more challenging of that being how we're going to handle our revenue recognition. Okay, but let's go ahead and let's take a look at the budgetary accounting. Okay, and let's just come down and go over to the next page, and they tell us that budgetary accounts are posted only twice. Okay, only twice, at the beginning of the year and at the end of the year, in which time they are simply reversed and closed. Okay, so let's just go ahead and look at the beginning of the year entry. Okay, and I want you to flashcard this journal entry, okay, which is when a government is determining that it's going to have revenues in the upcoming year. So maybe we're doing this in 2021 in anticipation of 2022. Nothing's happened yet. This is a budget. So we debit an account called estimated revenues. Okay. Now, when you look at that and you say debit revenue, you start getting creepy feelings, right? Because why would I debit a revenue account? I'm supposed to credit a revenue account, right? But remember, this is a budgetary estimated revenue account. So what I want you to do is go ahead and just come down and use this space down here at the bottom of this page. Let's just co-opt some of this space, and let's make ourselves a revenue ledger. Okay, and so in our revenue ledger, we're going to have different columns. We'll have a column for estimated revenue. We'll have a column for, let's even just change the color on that. We'll have a column for actual revenue. And then we'll have a column for balance. Okay, now what happens? I just debited the estimated revenue, didn't I? For 2 million. Okay, so what am I going to do? Okay, just back up there. This is the beginning of the year. Okay, I go ahead and I debit the estimated revenue for 1 million. So when I do, I debit that estimated revenue for 2 million. You saw that up there. The balance in here is now what? A debit balance of $2 million, right? Okay. Then this government gets into some activity. I don't know, maybe they issue some fishing licenses or something. And so they debit cash for, say, I don't know, 200,000, just making this up. And they credit revenue. So we're not messing you up that much, guys. If they've earned a revenue, you credit the revenue account. Now, when they credit the revenue account, they post that credit into this revenues ledger. And what's the balance in here now?
0.
Okay, not quite.
4.
Okay, I'm pretty sure it's 1,800,000, isn't it? I'm missing something.
Yes.
Okay.
1,000,008.
Yeah, so it's now 1,800,000, right? Okay, then what? Then they issue some more licenses. Say they get 500,000 worth of fishing licenses. They debit cash 500,000. They credit the revenue 500,000. They stick that 500,000 into the revenues ledger. So what's the balance here now?
1,000,003.
1,000,003. Okay, so that debit to estimated revenue really sits there as a placeholder so that as your actual revenues come in, you credit your actual revenues, you post that credit to this revenues ledger, and in the press of a button, a government can know how it's tracking against what it estimated its revenues to be, right? Budgetary control. Okay. Now, when we look at the rest of this beginning of the year entry, okay, notice that we credit appropriations control. Appropriations control is like, well, it's not like, it is legal spending. That says legal spending. A government cannot spend, that says legal spending. A government cannot spend money unless there is an appropriation that says they can. That's why a few times they shut down the government, because it wasn't, you say, why'd they shut down the government? Are they broke? And they play little games. They sit there and they say, well, we're broke, we're broke. That's why we can't pass the budget, because we're broke. And they say that. Meanwhile, you're sitting there, how are you broke? You're still collecting the taxes from me. Well, they have money, but they don't have the legal authority to spend that money. And so if they can't figure it out because of politics, they have to shut and I'm talking federal government here, they shut the federal government down because they don't have the legal authority to spend. Once that appropriation is approved, they have legal spending authority, and they would credit appropriations control, enter that into an appropriations ledger. Actual expenses would be what? Would be debits, and they could see at any point in time, now it's the mirror image of what I showed you, how they're tracking against their appropriations. And we're going to show you an appropriations ledger here tonight in a couple minutes, but you'll see it's simply a mirror image of that. Now, in this case, this government had what? Had a situation where they planned to have more money. They planned to collect more money than spend. So they were going to have what? A surplus. If a government plans to spend more money than it takes in, then they would debit budgetary control. It can't be both. It has to be one or the other, and that would be a situation where they have a deficit. The federal government almost always has what? A deficit. They always plan a deficit. Sometimes students think, oh, a deficit is an accident. It's an oopsie. No, the government does it on purpose. Why do they do it? Because they don't have many guts. Because they don't want to come and tell you that they're not going to be able to afford this, and they're not going to be able to afford that, and they're going to have to take this from you and that from you. They don't want to tell you that. And at the same time, they don't want to tell you we're going to raise your taxes. So what do? They just run a deficit period after period because they figure nobody's paying attention anyway, nobody gets it. And all of a sudden you end up with what? What is it? 25 trillion? I've lost track of debt. Okay. All right. So anyway, that's it. Now that debit to the estimated revenue, that credit to the appropriation sits there all year as a placeholder. But by the end of the year, we don't need it anymore because notice, guys, we're dealing with what? Temporary accounts here. We're dealing with revenue and things that are like expenses, right? So we close it at the end of the year, and the closing entry at the end of the year is the easiest thing in the world because it is simply reversal of whatever you had set up at the beginning of the year. CPA exam questions wanting to know, did you make a flashcard and memorize this simple little thing? Did you sit here and make a flashcard to know that you simply reverse that at the end of the year? And they really think they're asking you something there. Okay. Okay, good. Now let's go ahead and let's take a look.
So how does the actual revenue get tracked against this if you're just unplugging what you plugged in the beginning?
What was tracked?
Well, you tracked it there, but that didn't seem to, you just ended up reversing what, I mean, I don't see the interaction between the activity and the budgetary control thing. Or is it just, this is just gets it in there so you can monitor against it? Is that, I was confused by what the budget, by what all these accounts actually did.
Well, estimated revenue is what I estimate my revenue is going to be. Right?
No, I understand what they are, but if you're just going to reverse them out exactly as you put them in the beginning, like the activity.
So you want to do away with this?
No. I'm not saying that. I don't understand how it interacts with the other thing. I mean, or is it really just a placeholder so that you have something to benchmark your actual activity against? Is it like a memo entry or something in your general ledger system?
It's a revenues ledger. Okay, the term ledger means something I want to keep track of.
Okay.
Like you go to a hotel, you sign the ledger, the guest ledger, so they can keep track of who their guests were, right?
So would this be a column, say, if you were going to look at the books of a government entity, would this and the tracking of the actual activity against it be something that would be embedded in the general ledger that you just like activate at the beginning of the year and then deactivate at the beginning of the year? Is that what that is?
It would be in the revenues ledger. Like
okay. So it would be, where this thing, where the difference between the actual and the balance, the stuff that you showed here in this example, that happens in the revenue ledger? Is that?
Yeah.
Oh, okay. That's what I didn't understand, how the one thing got to the other place. So, okay, I got it now.
It's a revenues ledger. I mean, there's all kinds of things we can keep track of in accounting, right? And for government, they're keeping track of how they're doing against their revenue here. And the appropriations, it would be the mirror image. I credit the appropriation as I actually have actual expenditures. I debit them, and I know how I'm tracking against the spending on my appropriation, right? It's information that is used to achieve budgetary control during the year. And at the end of the year, I simply close those out, right? Just like I close my revenue accounts at the end of the year. Just like I close my expense accounts at the end of the year in commercial, right? Because I don't need to keep track of, I don't keep track of revenue for the entire existence of the company. I keep track of my revenue year by year, don't I? Okay, good. All right, so let's just come over though. And again, important thing, guys, is they're going to ask you questions that contemplate your being able to remember how to make this entry and how to close it at the end of the year. Okay, good. Now you come over and let's take a look at our actual, and they may not call it actual activity, okay, but that's what it is. It's actual activity. This is not budgetary stuff now. This is the actual activity, okay? And we have to look at our revenue recognition here, okay? And when we look at our revenue recognition, we need to focus on something called non-exchange revenue, okay? Most taxes are non-exchange. Mostly, what I should say is this is mostly taxes. Okay, and I'm going to ask you to see chart. C-H-A-R-T. See chart, and what I'm going to do is exit full screen here, okay? And I want to put this up. This is on e-learning, okay, this chart, okay? And what this chart gives us is the categories of our non-exchange revenue, okay? So what we have, these are all non-exchange, okay? These are all non-exchange, and what we have are categories: derived non-exchange, imposed non-exchange, government mandated non-exchange. I don't know why I always have to fight with them to put the word non-exchange next to all of these. I guess I could have corrected that myself. Government mandated non-exchange and voluntary. non-exchange. These are all non-exchange. Now, what does non-exchange mean? Non-exchange means you pay your taxes, money is paid to the government, and then we just expect them to be there for us when we need them. Okay, so that's why we say that, for example, sales tax, property tax are what? Are non-exchange. You don't sit there and pay your property tax and then, stand out in front of your house and say, well, give me some, government. What do? You pay your property tax and then you expect them to pay for the police service or whatever. So if you need the police, they're there when you need them, right? Isn't that how it's supposed to work? Okay, so that's called non-exchange. Okay, and they give me the example of this derived non-exchange, sales tax, income tax. Now they call it derived non-exchange because it derives its value from some underlying transaction. So what's the underlying transaction associated with sales tax? Not a trick question.
Sales.
The actual sale. Good. How about income tax?
Taxable income.
The generation of taxable income. Beautiful. Okay. Now, what requirement does the government have to meet in order to recognize that revenue, in order to have it appear on their income statement, essentially? And they tell us that they only have to meet time. A government does not have to meet eligibility requirement when it comes to sales tax, when it comes to income tax. If you don't believe me, try not paying it to them sometime and tell them they're not eligible and see what they have to say to you. Okay, so you're going to have to pay those taxes. There is no eligibility issue, but the government does need to consider time when it decides whether or not it wants to recognize, whether or not it should recognize that revenue under the accounting standards. So it says recognize revenue when the underlying transaction takes place. So if the sale took place in 2020, when can that government recognize that revenue?
2020.
2020. Good. If the sale took place in 2021 and the government isn't going to collect that revenue until January of 2022, when should it recognize that revenue?
2022.
Well, I heard a couple of things. Go ahead. Say again.
2022.
No, 2021, because the sale took place what? In
21.
21, when the underlying transaction takes place. Now, Abby, you do need to be careful because that's the rule if we're talking about accrual accounting. So if we're using accrual accounting for one of our funds, or we're using accrual accounting for, say, the government-wide statements, which we're going to learn, you'll use full accrual accounting, that's the rule. If it's modified accrual accounting, then when that money is going to be collected, I'm trying to focus this right here, when that money is going to be collected does become relevant. So notice I said they're going to collect it in January in my example. And so we said, hey, then for modified accrual accounting, it would be 2021 revenue. But if I told you they're not going to collect it until March, and our rule of thumb 60 days is applying, then even though that would be revenue under accrual basis, for modified accrual, we wouldn't call it revenue. We would have another category called deferred inflow, which we've already talked about is the what? Is the thing that's the cocoon. It's not still a worm on the ground. It's a cocoon, but it's not a revenue butterfly yet. In other words, it hasn't hit the income statement yet. Okay. Now, just to illustrate that some more, and don't worry, we'll get back to the book here in a couple of minutes. But what I want to do is take you to some more slides that I have here, this one, okay? And, you know, I think, let me see. Can I erase all this scribbling? Yeah, I don't want all this scribbling right now. I'll scribble on it again here for you so you can see how I scribbled. Okay, so and the version on the what do they call that? E-learning has those scribbles. So, okay, but I just want to go ahead and mark it up as we go along. So let me see if I, yeah, okay, good. Okay, so what happens? We sit here and we have this situation of sales tax, right? Which is a derived non-exchange revenue. And they have the first quarter, second quarter, third quarter. So first quarter is going to be, in this example, what? October, November, December. And the second quarter is going to be what? January, February, March. And then the third quarter would be what? April, May, June. And then the fourth quarter is July, August, September. Let me just go ahead and write out that a little bit. October, November, December. It says November, December. Okay, October, November, December. Okay, so what happens? They have sales of 46,000 in the first quarter, and they have a sales tax rate of 6.25%. So the tax is $2,875. And in this example, they collect the sales tax in the quarter after the quarter of the sale. So in other words, they're going to collect the first quarter sales in the second quarter. Right? Okay, the taxes from the first quarter get collected in the second quarter. That's why they're saying, hey, this NA is to what was collected in the first quarter, because that was related to the fourth quarter of the previous year, right? Okay, so that's why they're saying it's irrelevant here. And so notice that in each case, they collect the taxes in the next quarter. But when we get to the fourth quarter, notice that there's what? They collect 1113 in that now first quarter of the next year, but 200 here, what? Falls down into December. So 200 does what? 200 falls outside of 60 days, doesn't it? All of October, all of November. Okay, so we've got an issue here where if you're looking at what? If you're looking at the accrual accounting, you would take what? As revenue, all of the money, because the underlying sale took place in 20, whatever year this would be, in 2021, let's say fiscal 2021. Whereas what? For modified accrual, that 200 that fell outside of the 60 days, notice that is a what? Deferred inflow, and we only take the revenue for the amounts that we actually were able to collect from that fourth quarter as the revenue piece of that setup of that accrual of the amounts that were still receivable at 9/30. Now, sometimes students have a little bit of trouble with this example because they're saying, well, John, how would they know what they collected by the time they prepare their financial statements? Well, they probably would know because they're probably preparing these statements, what? In December for issuance sometime in January, whatever. So by then they would know what they actually collected, and when they collected it, but for financial statement reporting purposes, for full accrual, yeah, the whole amount, everything that was where the underlying sale took place as revenue. For modified accrual, you'd have to exclude those amounts that got collected outside of 60 days. Question? And that's a deferred inflow. Okay.
That 200, why was it collected outside of 200 days? That's just the way the facts of the example, or was there
Yeah, just the facts of the example. I don't know. We've got some amounts that are lagging in for whatever reason.
Okay.
Yeah.
Is there an assumption about what fiscal year end there will be on governments, or is that going to be something that should be supplied in the problem, or what should be
that
the
would be
default?
supplied in the problem. different governments have different fiscal year ends. So states tend to have their fiscal year end on June 30th, starts
Okay.
July 1st, ends June 30th. Counties tend to line theirs up with the federal government for some strange reason. I don't know why. So counties tend to have a 9/30 year end. Federal government has a 9/30 year end, fiscal year end. So it tends to be for states 6/30, for everybody else 9/30, but you have to read the question to see.
Got it. Thank you.
Yeah. Yeah, it's somewhat convoluted as to how they do that, the fiscal year ends. Okay, good. Now, and then they change it every now and then. No, the federal government says the fiscal year end is okay. Why did you have it to begin with on October 1st as the start? And why do you have to change it now? So it's a little annoying, but that's how it works currently. But you just read the question. Okay, now that's for the derived non-exchange. Imposed non-exchange. Again, the trick here, guys, is by category, because the rules change depending on what category of revenue you're in. So for the imposed non-exchange, example, property taxes, fines and penalties, what happens? The government comes down and tells you, this is the value of your house, pay me 1% of it. They don't tell you, they impose it on you. They don't say, hey, okay, what do you think? They tell you, and try not paying them. They will put a lien on your home, right? Okay. So what happens? So with a fine, they put a parking ticket on your car, you pay the fine, right? Now, again, just like the derived non-exchange, government doesn't have to ask itself if it's eligible for property taxes. So we only need to worry about time. And here the time rule is when use may first begin and the government has a legally enforceable claim. Now, the legally enforceable claim, let's just talk about that real quick, is that really pertains to the fines. So what happens? If a government puts a parking ticket on your car, and let's say they have a calendar year end of December 31st, and they put a ticket on your car December 31st, do they have a legally enforceable claim? They do not. You have the right to take that to court. They give you a due process time. So you've got 30 days, et cetera, that you can basically fight that and whatnot. So they really can't take the revenue until what? Until any due process period has passed. I was on an assignment looking at US Forest Service, and I nailed them with a finding. What they were doing is they were booking as revenue billings that they had given to farmers and whatnot that had been doing controlled burns. And then I guess the controlled burns got out of control and burned Forest Service land. So they billed them for the lost Forest Service asset, but they hadn't gone, and they were booking a revenue for that. But in many of those cases, they hadn't gone through the due process. And I was like, no, that's not revenue, because you don't have a legal enforceable claim until they've been able to go through their due process. Okay. Now, where it applies to property taxes is when use may first begin. Let's focus on that one, okay? So I've got another example up on Canvas for that, but I'm going to get it right here. Okay, but it's up on, not Canvas, e-learning. Okay, and let's just take a look at this. I know it's a little hard to see on the screen, guys, so try to do what you can do to follow this along. And so what happens? I have a government, and I say use of funds may begin in 2019 to finance 29 activities. So notice they mail out the property tax bills in November of 2018. Now they do this because, you know, they want to give you some time to weep or whatever it is before you have to pay your property taxes. So they mail them out in 2018, even though they're not due until what? Until 2019. And the money that they get has to be used. Use may first begin to finance actual 2019 activities. Now, when you look at this, both for the government-wide statements, and I'm saying general fund because I'm going to be comparing accrual to modified accrual here, we have to go ahead and debit taxes receivable and we credit deferred inflow because they haven't met the time requirement. They can't use that money until what? 2019. So even though they're mailing out the tax bill in 2018, because they can't use that money to 2019, they haven't met the time requirement. And so they go ahead and credit deferred inflow, both at the full accrual, government-wide level, and under modified accrual. Now, they collect 100,000 in December of 2018. Some people pay their property tax bill immediately because they don't want to forget, or maybe they want the tax deduction. Although in the state of California, I don't bother to pay mine until it's the last day that it's due because they screwed us over on the tax deduction for that. So I'm going to hold my money to the last day. Okay. So, you know, if you're thinking they did you any favors with the Tax Cut and Jobs Act and you own a house in the state of California, they did not. Okay, but anyway, so you go ahead and you debit the cash, you credit the taxes receivable, and I don't do anything yet because I'm not, in terms of recognizing revenue, because I'm not in 2019 yet. Then in 2019, January 1st, 2019, when the calendar flips over to 2019, use may begin. So I've met the time requirement, which is all I have to do at the government-wide level. So for the government-wide level, I debit the deferred inflow. I take that all, in this example, as 2019 revenue. At the fund level, I have to be careful because if there are some amounts of these property taxes that creep outside of, and I'm assuming 60 days here, then I can't take that as revenue. So as a practical purpose, I'm only going to take them as revenue as I collect them. So what I do is I go ahead and for the general fund, I debit deferred inflow and I credit the revenue 100,000. Now, if you look at the government-wide ledger for deferred inflow, it's now 0, isn't it, guys? Because I've debited the deferred inflow. If you look at the taxes receivable ledger is the same for both and not very interesting, I guess, because now it's down to 1.9. But if you look at the deferred inflow account for the general fund now right here, notice that what I've only debited for 100,000, I still have 1.9 as a deferred inflow. If you look at the 2019 revenue ledger now for my general fund, it's only showing the 100,000. If you look at the revenue ledger for the government-wide, the entire amount is 2 million because I don't have that 60-day requirement. I've entered the year in which use may begin, right? And I'm not worried about when I'll actually collect the money. So then we go on with this example, okay? And what happens? I, in April, collect $1 million. I debit cash, credit taxes receivable. Okay, I didn't keep track of the cash here, guys, because it's not particularly relevant to the understanding. So now I have what? Tax receivable still outstanding of 900,000. I don't have to do anything to recognize revenue at the government-wide level because what? Because I've taken all the revenue for the entire 2 million. Okay. And then for the general fund, as a practical purpose, I take the revenue as I collect it. So now I go ahead and I debit deferred inflow, credit the revenue. So now my revenue for my general fund, for my governmental fund, using modified accrual accounting is going to be what? Going to be 1.1. There's that credit of $1 million. And I go ahead and I debit the deferred inflow. And so I still have 900,000 deferred inflow because I haven't collected any of that yet. And I'm waiting until I collect it to recognize the revenue. Okay. Then I go on and in September, I collect a little bit more. I debit the cash, credit the taxes receivable. Taxes receivable now is what is showing the 100,000 that's still left to collect. And I sit here and I can now do what? In my general fund, I can now debit the deferred inflow, credit the revenue right here, debit the deferred inflow right here, credit the revenue. So I've taken another 800,000 now of revenue. And so when I take that 800,000 of revenue, I go ahead and I can credit the revenue. It's now up to 1.9 million. And my deferred inflow now is down to 100,000. Then I collect what? 25 $75,000. I collect that in January of 2020. So now I'm in 2020. I'm out of 2019, but I'm still, if I'm assuming 60 days here, within the 60-day criteria, right? So I can do what? When I collect that 75,000, even though it's collected in 2020, I'm going to report that in the 2019 revenue ledger. So I debit deferred inflow, I credit revenue for the 75,000. When I do that, of course, I still have the 25,000 left to collect. That's in my receivable. And I do what? I credit my revenue for the 75,000. Now that's all my revenue for 2019. And I debit the deferred inflow for 75,000. I've got 25,000 left, right? Now what happens? Then I finally collect that last 25,000, and I collect that last 25,000 in March of 2020. Well, now I'm outside of the 60 days, right? So what happens? I go ahead, I obviously would debit the cash, credit the tax receivable. There's no more receivable from 2019 now anyway. And I would go ahead and debit the deferred inflow and credit revenue, but notice it's what? It's 2020 revenue, isn't it? It's 2020 revenue because it fell outside of the 60 days. So that's going to go in the 2020 revenue of 25,000. I debited the deferred inflow. It's now zeroed out. And of course, my receivable is zeroed out. So I apologize. I know that's a long way to go to simply tell you that the difference between the two is what? Is whether you collected it outside of the 60 days. And I could say that to you and you wouldn't understand it. Okay. Okay, good. Now that's looking at what? Going back. Now that's looking at two of the items on our chart where it was time. Right? One was when did the underlying transaction take place? The other time consideration was what? Was when use may first begin or when the government has a legally enforceable claim. Okay. Now, government mandated. What happens here? Well, government mandated happens when a higher level of government tells a lower level of government they have to do something. For example, the state tells the county, you have to keep your water clean in your county. Now, why does the state have the right to tell the county that?
It's higher level.
It's higher level, and the water that flows from, Alameda County could end up in Contra Costa County at some point in time, right? Okay, now these days, with the craziness we have going on now, I could actually see a county saying, well, we're not going to do it, okay? But in more sane times, they say, okay, we'll do it. But you know what? We don't have the money to do that. And so the state says, no problem. I'm going to give you the money to do what I want you to do. And you must use this money during the state's fiscal year. Now, what happens? The state has a fiscal year that begins what? July 1st of, say, 2021. Meanwhile, the county's fiscal year starts what? Starts October 1st, 2021. When should the county take that revenue? Should they take it in October or should they take it in July when the state's fiscal year has begun?
The state.
July.
They use the state's fiscal year and they take the entire amount. Okay, so you might sit there and you want to say, oh, well, we have to allocate it accordingly. It doesn't matter. Even though a good chunk of that money will probably be spent in the next fiscal year for the county, because they're saying the state's fiscal year started July 1st. July 1st, 21 was the start of 2022, fiscal 2022. So since most of that money is going to be spent in the county's fiscal 2022, take it in fiscal 2022, They were eligible to begin to use that money in what? In county's fiscal 2021. All of that amount goes in the county's fiscal 2021. Again, it is more of a time requirement. Now, the only time that eligibility, because they do mention eligibility here, comes in for a government mandated if it's a reimbursement grant. In other words, reimbursement mandate. In other words, they say, we'll give you the money after you spend the money. Well, now to be eligible, what do you have to do? You have to spend the money. So you would debit expenditure, credit cash, debit receivable, credit what? Revenue, because you've met the eligibility. And then there is no time requirement. It doesn't have to be, every situation doesn't have to have both. They don't have to have eligibility and time. Where eligibility actually becomes interesting is in voluntary non-exchange competitive grant programs. Okay, what happens here? Well, now an entity like HUD gets different proposals for different community development projects. And what they do is they literally will sit there and go down and decide which projects are worthy of the money. And so when you get told, hey, congratulations, you have been awarded, your bid was one, your project was one that has been accepted, you're now eligible. Now you could still have time requirements. They'll say, well, you're eligible, but you can't start using that money until next year. So what would you do? You would debit grants receivable, or they may even give you the cash. You'd credit deferred inflow until you get into the year when they actually tell you can use the money. So here, eligibility really means something. You have to really know that they've told you that you're eligible, and then you have to consider the time, when may I use the money? Okay. All right. So those are our categories. This is a useful chart. All of these, as you've seen, get subject to the 60-day criteria. So even though you go through all these rules for accrual accounting, for modified accrual, you'd always have to remember, and again, read the question carefully to make sure it's 60 days, because it doesn't have to be 60 days. And with all that, what I want to do is go back now to the book. Any question on any of that before we go back to the text here? Okay, good. And you see, guys, now the book is going to start to call out derived. These are all non-exchange. Derived non-exchange, imposed non-exchange. Okay, I'll come back to this example. Government mandated non-exchange and voluntary non-exchange. Same thing we had on the slide, right? Okay, so I've just repeated that on the slide, but I like the presentation better. Okay, now what happens? Revenue recognition, time requirements, applicable to all non-exchange revenue. Eligibility requirements is only applicable to the government mandated and the voluntary. Okay, now where it is applicable to the government mandated is if it is a reimbursement, right? You had to go ahead and spend the money, right? The voluntary was what? Voluntary was contingencies only, actions must be taken before revenue is earned. So that's the voluntary non-exchange, is where they tell you, hey, you're eligible, right? Where the eligibility only comes in for the government mandated if it's a reimbursement type grant, type of mandate. Okay, so go ahead and flashcard that the eligibility requirements are only applicable to the government mandated and the voluntary, and note that what for the government mandated, it's where reimbursement comes in, whereas for the voluntary non-exchange, it's contingent on them approving that revenue for you, that higher level of government. Okay. Okay, good. Let's come down to the pass key. Okay, and we've really kind of have said this, but I think it's worthwhile to repeat it. All revenues are subject to time requirements. derived and imposed, only subject to what? Time requirements. Only government mandated, voluntary non-exchange are subject to what? Voluntary, and only voluntary are subject to contingencies such as being approved. So you're like, well, okay, well, when does, the government mandated become eligible, and it's for what? It's for the reimbursement type. Question. Okay, good. Now, I said I want to come back to this. Okay, now, for this example, we are assuming that this government has met time requirements for property taxes. There is no question that they're in the period as to when they can recognize the revenue. So the only real takeaway from this question is how to handle estimated uncollectibles. I'm going to repeat that. The only takeaway from this example, other than what we've talked about, is to show how to handle an estimate for uncollectible taxes. That's all we're doing here. Okay, so what happens? We sit here and we mail out the tax bills for our taxes receivable, our property taxes. We debit tax receivable current. We credit the revenue, and we debit the allowance for uncollectible taxes. We reduce the revenue by the amount we think we're not going to collect. Different than what you would do under what? Under commercial accounting. Under commercial accounting, you'd take a bad debt expense, wouldn't you? Okay, but since we're not providing any kind of service here, it's a non-exchange revenue. Rather than take an expense to match revenue that you've earned with the expense, no, we simply reduce the revenue by the amount we think we're not going to collect.
So that's not really a contra account, is it? Because you didn't.
What is not a contra account?
Allowance, this allowance.
Oh yeah, no, it's a contra. You report the taxes receivable current gross minus the allowance for uncollectible taxes, which is a credit, which show net real property tax receivable of 1,620,000, right?
Okay.
The difference is you're not debiting bad debt expense.
Okay.
From commercial. The balance sheet, if I just showed you the numbers, you wouldn't be able to tell me the difference between a commercial balance sheet and a government balance sheet, whereas the income statement would look different. For the commercial entity, they would show revenue of 1.8. For the government, they'd show revenue net of 1,620,000. Okay. All right, good. Now, the good thing about being a government is you send property tax bills to people, you don't do anything, and they send the money to you. Look at that. They just sent the money. But there's still what? There's still some 342,000 that hasn't been sent in, and now they go past due on those. This is still a current asset, guys. We're talking about what? We're talking about government funds, the general fund, the governmental funds we're talking about here. And it's still a current asset, but now we simply label it as delinquent, as late. So we debit tax receivable delinquent, and we credit the tax receivable current. Now, what happens? If you take that 342 that we've collected, that we still haven't collected, right? You started out with what? 1,800,000. Just make sure we understand where the 342 is coming from. They tell us we've collected what? 1,458,000. So we still haven't collected 342, right? And they decide, and it's now late, it's now delinquent, so they put it in delinquent, and then they decide to hell with it. We're not going to collect any of that. So they decide to put the whole amount into the allowance. So what are they going to do? They're going to go ahead and they will debit allowance for taxes current. That's what? Reversing out that 180, okay? They're going to do what? Put the entire 342 in the allowance, what? The allowance now for delinquent, and they're going to reduce the revenue now an additional 162 to bring them up to the full 342, right? So I guess it also had in there how to reclass from delinquent to current. But the main takeaway is how to what? How to account for uncollectible, right? Question. Okay, good. Let's look quickly at expenditures. If there's no question on revenue, let's look quickly at expenditures here, and capital expenditures, spending money on things like fixed assets, etc., are considered what? Are considered an expenditure. You don't debit asset, you debit expenditure. So both police cars and police salaries are treated as expenditures. Okay, with all that, I have to stop because the next thing we're going to look at is a couple different methods of accounting for inventory, and I cannot get to that in the time we have left. And I have another example for you up on e-learning. So I've supplemented quite a bit of this material with additional examples, which some people would argue is overkill for the CPA exam. If I'm teaching the class at the university, I do these additional things, but I feel like it gives you a little more contextual sophistication with some of the things, so you're not always kind of feeling that uneasy sort of loose understanding feeling as you go through some of this stuff. So at this point, you should be able to finish the modules for the not-for-profit. And unfortunately, we're going to have to finish up chapter 8 next time, and hopefully maybe even make some good headway into chapter 9. Question? Okay, guys, I'll see you next time, next Thursday.
Thank you.
Thank you, Professor.
Okay, have a good night, guys.
Good night.
You.